Ladies and gentlemen, good day and welcome to the Aptus Value Housing Finance India Limited Q4 FY25 earnings conference call hosted by Dolat Capital. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Mona Ketan from Dolat Capital. Thank you, and over to you, ma'am.
Thank you, Sejal. Good morning, everyone, and welcome to the earnings call of Aptus Value Housing Finance India Limited to discuss its Q4 and FY25 performance. We have with us the senior management from Aptus to share industry and business updates. I would now like to hand over to Mr. Anandan for his opening comments, post which we can open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Mona. Ladies and gentlemen, good morning to all of you. I am Anandan, Executive Chairman of the company. I welcome you all to this conference call to discuss the company performance for the quarter year ending March 25. I have with me Mr. P. Balaji, MD, Mr. C.P. Manoharan, CBO, and Mr. Sanjay Mittal, CFO, and Mr. John Vijayan, CRO. At Aptus, we believe in strong growth without losing focus on the quality of the loan book and good financial metrics. We're very happy to record that Aptus had a very good FY25 supported by business growth, stable asset quality, continuous focus on higher productivity, and a robust business model, good distribution network, and penetration in served markets, deep penetration in served markets, customer centricity along with appropriate tech initiatives, and diversified product and income stream have enabled the company to achieve good business results. Our net worth, as you are aware, stands over 4,300 crores, and the capital adequate capital adequacy. This coupled with good support from banks, NHB, mutual funds, and BFI on the borrowing side, and with strong on-ground demand for both home loans and small business loans, gives us confidence to pursue strong growth, scalability in the years to come with sustained profitability. Further, to support our vision of reaching loan book of rupees 25,000 crores by FY2028, we've been continuously strengthening the organization by way of investing in new branches, relevant technology, and strengthening the company with quality manpower across all functions, more particularly in the middle management. I would now hand over the line to Mr. P. Balaji, MD, to discuss the business focus operating financial parameters. Thank you.
Thank you, sir. Good morning, friends. As we have been explaining in the earlier calls, we will continue to focus on our key strategies, which are as follows. Growing disbursements and loan book, both in housing loan and small business loan, considering the large headroom available in the low and middle income segment in Tier 3 and 4 cities. Expanding operations contiguously in the states of Odisha and Maharashtra and increasing penetration in existing geographies by opening new branches. Strengthening analytics and digital adoption. About 21% of our business in Q4 FY25 has come from customer referral app, construction ecosystem app, and social media channels. Our focus shall be to increase the leads through these channels in addition to the leads from the physical branch network. Continue to focus on productivity, collection efficiency, OPEX, and cost of funds. The new mobile-first lead management software, which was launched in April 2024, has settled very well and is bringing in good improvements in terms of streamlining of our processes, service delivery, lesser bounce rates, improved collection productivity, better regulatory compliance, and improving overall efficiencies. We are continuously monitoring the functioning of this new system to bring in more improvements. Now coming to the major performance highlights, our AUM grew by 25% year-on-year to 10,865 crores. Disbursements grew increased by 10% year-on-year to 1,064 crores. Disbursement growth for the year was at 15%. We have 300 branches as on 31st March 2025. Of this, 10 branches are in the states of Maharashtra and Odisha, and the balance 290 branches are in the states of Tamil Nadu, Andhra Pradesh, Telangana, and Karnataka. Total branches added for the year were at 38. Total live customers crosses 1.6 lakhs. It is 21% growth year-on-year. NPA was at 1.19%. Now coming to the asset quality, collection efficiencies were at around 101.16%, and our 30 plus GPD improved to 5.91% as on 31st March 2025 as compared to 6.21% as on 31st December 2024. Net NPA was at 0.89%. Provision coverage has been consistently maintained at around 1.03%. We are carrying a total provision of around 111 crores, including a management overlay of 55 crores, and this, when computed as a percentage of NPA, works out to a coverage of 87%. Credit cost for the quarter was at 0.3%, which was almost similar to the previous quarters. NIM was at 12.96%. OPEX to assets were at 2.63%, despite investments in new branches, technology, and HR. PAT was at 751 crores for the year, which is a growth of 23% year-on-year. ROA was at 7.73 and ROE was at 18.76%, which is one of the best in the industry. For the quarter, the ROE crossed 19% and was at 19.66%. Now coming to the funding, during the quarter, we diversified our borrowings further by issuing NCDs aggregating to 325 crores to mutual funds. Of the total borrowings, 52% are from banks, 15% from NHB, 19% from NCDs issued to IFCs and mutual funds, and the balance is in the form of securitization. As on 31st March, we had sufficient on-balance sheet liquidity of 1,155 crores, including undrawn sanction of 678 crores from banks. I would like to highlight one of our strategic shifts in the funding approach this quarter. We executed our first direct assignment transaction for a small amount of around 75 crores of non-housing portfolio in our housing finance company. As you are aware, we have historically maintained a conservative stance and stayed away from DA. However, given the evolving funding environment and the long tenure nature of our book, we saw merit in exploring DA, which will complement our strategy for both diversification of borrowing and ALM management. This also helps us to strengthen our PBC criteria. Going forward, we will be looking at doing DA transactions on a selective basis. With this, I close my remarks and I open the floor for the question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi, good morning. Congratulations on good performance. My question is on disbursement growth. So while first half of the year was impacted, but when you look at second half, which was pretty normal, even in second half, the disbursement growth was 15% by and by. So, I mean, can you share disbursement growth figures, say, at the state level? Because when you look at the state-wise, growth momentum, then Tamil Nadu seems to be coming back, but AP seems to be losing some steam. So, firstly, you can comment on how can we improve the disbursement growth on an overall basis from 15%? And are there any geographies which need to be focused and to improve the disbursement growth, particularly AP?
Thanks, Rajiv, for the question. I'm sure this question might be there with all the people. I'll just explain it for the benefit of others as well. If you look at our disbursement growth, as you rightly said, it is 15% year-on-year. But if you look at our 3,604 crores of disbursement, this is actually a 11-month disbursement as against a 12-month disbursement of last year, which was at around 3,127 crores. So if you factor in that 1 month disbursement, the disbursement growth would have been around 18 to 19%. And if you look at the year-on-year disbursement for the last quarter, it has grown by 10%. Basically, it is because of the base effect. If you look at our disbursements last quarter, Q2 FY24 was around 750 crores and Q3 was also 750 crores, which spiked up to 968 crores in Q4 FY24. But in FY25, the disbursements have actually evened out. If you look at our Q2 FY25 disbursements, it was 935 crores and Q3 was 930 crores and Q4 it has become 1,064 crores. So it is actually because of the base effect the growth is at 10%, and it is not because of any market sentiment or not market availability. So and also, as you rightly said, Tamil Nadu has also almost coming back to normalcy with other assets under management growing at 14%, and Tamil Nadu growth quarter on quarter was 14%, and year on year was around 11% on the disbursements. So actually, we are not seeing anything on the ground. It is basically the base effect which has had an impact on the growth.
Okay. Sir, basically, I was actually looking at the second half only because second half was pretty normal, and that kind of, adjusts the base for making it more comparable. So even in the second half, the disbursement growth is 15%. So the point is, if we were to grow at 25-30% in the next year, if that is the aspiration, then given the current runoff rate, we need to grow our disbursement next year by 26-27% on the current year base of FY25. So can we scale up to that kind of disbursement growth in FY26? And what can be the sources of growth improvement? You can talk about branch addition plans. You can talk about how the productivity at the sales officer level can be improved. Whether do we need to do more sourcing from alternate channels and how could that be driven? Just wanted to get more clarity on how the growth in disbursement will come about at a much higher level for us.
If you look at even at the 15% disbursement growth, the loan book growth has been at around 25%. So for the year FY26, our guidance will be around 24 to 25% of disbursement growth and around 28 to 30% of loan book growth. But how this will be achieved, I'll give you the following things which will be focusing. One is, the first thing is the new business from new branches in new states. Basically, in Odisha and Maharashtra, we already have 10 branches. We'll be opening 10 more branches in this year. So the business from those branches will contribute to the growth. Next one is business from new branches in the existing states. So in this year, we are planning to open a total of around 40 branches. So the business from that will contribute to the growth. Then next thing is impact of full year business from the new branches which has been opened last year. We have opened 38 branches. So the full year contribution of those branches will also contribute to the growth. Over and above that, the productivity improvement in the sense that actually increasing the ATS. Currently it is around 8 to 8.5 lakhs. We want to increase it to around 9 to 9.5 lakhs without impacting the LTV and the installment to income ratio. So that should contribute to the growth. And also improving the per loan officer productivity, which is currently around 3 to 3.2. That is, we are planning to make it up to 4 per loan officer per month. And also having optimum number of people at the branches, that will also contribute to the growth. Over and above that, we have this digital marketing initiative which is working fine. With 21%, at least we want to make it up to 25% immediately, and then in the years to come, we'll be making up to 30%. So this is actually, all this has been broken down across branches and also the sales officer wise, which gives us this confidence of growing, giving this guidance of around 24 to 25% disbursement growth. And also loan book growth of 30%.
Okay. And just on funding side, you can share the incremental cost of borrowings, now for the HFC and for the NBFC from the banks. And also please give us some color on how the existing bank loans will reprice down. what is the benchmarking of it and how it can reprice down in the coming quarters? And lastly, on NHB funding, is there any sanction in hand or any pipeline for that?
Yeah. In the as regards the funding is concerned, the rates of interest of housing loan HSP borrowings is around 8.5%. It continues, and 8.5 to 8.7%. And on the NBFC, we are still borrowing between 9 to 9.25. But having said that, if you look at the total borrowing, 56% of our borrowings is variable, which is linked to a variable rate interest rate. Of that, 30% is linked to repo rate, which means for that I will get a benefit of at least 0.5% in maybe in this quarter itself. Already we have got 0.25% reduction in 2 or 3 borrowings which we have taken, and this is likely to come in. And of course, the balance 26% on the MCLR, which is linked to MCLR, the interest rate reduction can start coming from June to July. So, and of course, incremental borrowings will be negotiated hard for bringing in those kind of interest savings. So, that is broadly on the interest rates. And NHB borrowings, we have got a sanction of 300 crores. We'll be taking a decision on when to take that money out.
Great, sir. Thank you so much for answering my questions and listening.
Yeah.
Thank you. The next question is from the line of Renish from ICICI Securities. Please go ahead.
Yeah, hi sir. Congrats on a good set of numbers. So just two things. One on this provision on the stage 2. So when we look at stage 2 assets, it actually fell by 20 basis points sequentially, wherein the PCR actually gone up to 8.5 versus 7.8 sequentially. So just wanted to get a sense that what is driving this high provisioning in stage 2? I mean, is it due to we see some stress in some pockets, or how one should look at this number, sir?
Yeah, actually speaking, we are not seeing stress in any of the markets or any of the products. See, what has happened in the housing finance company, the bad debt recoveries were good, and we have recovered almost 5.5 to 6 crores during the quarter. And we wanted to maintain the provision coverage ratio at around 1.03%. And in the NBFC, the loan book from 1,900 crores has gone to 3,000 crores. So we wanted to strengthen the provision coverage there, and we are still maintaining at 1.03%. So that's the whole reason this number is there. And if you look at the credit cost, it has remained the same at 0.3%.
Correct. And just to follow up on that, so do we foresee any derailment either on growth or collection due to this Tamil Nadu bill?
This Tamil Nadu ordinance, yes, it is a fact that it has been announced by Tamil Nadu government. But what we feel, I mean, it has been clearly stated in the ordinance that it is applicable only to unregistered MFI or money lenders who are charging usurious rate of interest. So the kind of customers whom we serve, basically with an average ticket price of around 8 to 9 lakhs, our initial feeling is that we might not get affected very much. We feel that the impact can be there in MFI and also low ticket loan providers. So of course, this is initial days. We are having a very close watch on this. As of now, we are not seeing that kind of trends. Our collection efficiencies are better, but we are watching this closely.
Got it, sir. And sir, my last question again on this geographical concentration and the growth trajectory. So when we look at last 5 years, sort of we have been able to reduce the dependency on TN market, with its share falling to almost 33% in FY25 from 52 3-4 years back. But at the same time, AP share is now more than 40%, and AUM touching almost 4,500 crore. So just wanted to get a sense, on this base, whether this 30% plus growth rate is sustainable in AP market, and let's say if you feel that there is still under penetration in this ticket segment and will be able to grow at 30% plus in AP. So then in next 2 years, our dependence on AP will further increase, right? So what is the plan to de-risk the growth from over dependence on any one state?
See, actually, if you look at it, that's the reason why we have ventured into this Odisha and Maharashtra. So the business, which was around 5 crores, the AUM 2 years back, it has become 55 crores as of now. It is a healthy growth according to me, because first year was formative year for these two states, and after that, the growth has come. So we will be getting more growth from Odisha and Maharashtra this year. So to that extent, the AP growth will come down. But having said that, the penetration in, still the market availability in AP is quite huge. So that is also going to contribute. And with Tamil Nadu coming back to normalcy, so the distribution of AUM is likely to improve across states. And of course, Karnataka also is likely to chip in more.
Yeah, just to add to what Mr. Balaji said, Anand here, while we have 113 branches in Andhra Pradesh and having a good growth rate, as I mentioned, but we see a very good opportunity in Telangana as well, where we have currently only about 53 branches, and even the current year, the growth rate in Telangana is one of the best. So in Telangana, we have grown by 31%, same as Andhra. Well, Andhra base is higher, as I mentioned, but Telangana growth is much lower, giving an opportunity not only Telangana, even Karnataka for that matter, in addition to the Maharashtra and Odisha that Mr. Balaji has mentioned.
Got it. And maybe just the last question on the spread from my side. So let's say we already seen 50 basis point of repo rate cut in, let's say, over the next 6 to 9 months, if there is another 50 basis point repo rate cut. Where do you see the spreads settling from exit Q4 quarter numbers?
If you look at this, as I told in the earlier remark also, if you look at the total borrowing, 30% is linked to repo rate. So if you factor in a 50 basis points cut on that 30% borrowing, it will be 0.15% reduction that can come in. And of course, we don't know how much more rate cuts are going to come, but if it comes, that benefit also will come in. But also this 26%, which is linked to MCLR, the interest rate reduction can start coming in from maybe July or so. That's what I'm getting to hear from banks. So if that comes in, that will be another added bonus. The thing is that this is where Aptus is slightly standing out because we have got this 80% fixed rate loan book. So spreads are likely to improve. Spreads are likely to improve because of this interest rate reduction.
Got it. So we don't foresee any pressure on the asset yields, at least in the term.
Yes, absolutely.
Oh, okay. It's great, sir. Thank you and best of luck, sir.
Thank you very much.
Thank you. The next question is from the line of Kushan Parekh from Morgan Stanley. Please go ahead.
Thank you for taking my question. I just had questions around the credit cost. There seems to be some reconciliation between the prior quarters, essentially when we look at the 9 months reported number versus the full year number, in the other income line, which gets knocked off in the credit cost. If you could just help us explain that. And also, secondly, if you could help us explain the reconciliation between the standalone credit cost and the Aptus Finance NBFC credit cost, which came in higher this quarter, whereas the consolidated credit cost seemed largely in line with what we had in the previous quarter. So if you could just help us explain that as well. Those were my 2 questions. Thank you.
I'll explain this question. See, there have been RBI has directed all the NBFCs to, we have to go for a change in auditors every 3 years. So there are some auditors who are telling that the bad debts recovered has to be shown separately in other income. But there are some auditors who say that it has to be netted off against the ECL provision. So it's basically we go by that auditor's opinion, and this quarter onwards, we have netted it off against the ECL provision and the credit cost, whatever is the bad debts recovery. So that's the answer to the first question. Then the next thing is on the reconciliation. If you look at it, what is the question on the reconciliation? I was not able to understand.
Sure, I'll just repeat my question. So, essentially, we had about 80 million credit costs in the NBFC subsidiary and a small 20 million credit costs in the standalone book, whereas the consolidated credit cost has come at around 79 odd million. So if you could just help us with the reconciliation math on that.
Yeah, I'll explain. See, what is happening, if you look at it, in the housing finance company, the bad debt recovery was high during the quarter. Okay? So, which was almost 5.5 crores to 6 crores, which got netted off in the standalone financials. Whereas in the NBFC, what has happened is, we all know from 1,900 crores, the book has grown to 3,000 crores. So there is a strengthening required on the provision front in that company. So we have provided more there to take care of the 1.03% provision coverage ratio. If I don't do that, then what will happen is I need to write back the provision, which will only result in additional capital. So we wanted to maintain this 1.03%. That is why this is that.
Understood. That's actually quite helpful. Those are my questions. That's all.
Thank you, Krishna.
Thank you.
Thank you.
The next question is from the line of Yash from Citigroup. Please go ahead.
Hi, sir. Thanks for taking my question. So one is on the operating expenses, which sees sharp, a jump quarter on quarter by 11% or so. So is it one-off or it is largely volume linked?
No, actually, it is volume linked if you look at our OpEx. But what has happened, if you look at it, we have invested in branches, we have invested in technologies, new lead management system. So all this is contributing to this increase, but still ours is one of the best. If you look at the OpEx to assets, it is around 2.63%. And even if you look at the cost to income ratio, on the gross income, it is maintained at around 14%, both for the quarter and also for the for the full financial year. And if you look at the net income, it is around 20%. I mean, after deducting the interest cost, it is being maintained at 20%. So this 2.63 to 2.7% cost to assets will continue. That will be the guidance from us.
2.63 to, sorry?
2.63 to 2.7%, yeah.
2.7. Okay, got it. And so second is on the balance transfer out, if you can share the trend on it, given, our housing loan yields are north of the peers at 15.5%. So are we seeing any increase there?
If you look at the balance transfers, we have been consistently, it is around 2 to 2.5%. While our pre-closes are around 7%, the balance 4.5%, the pre-closes are coming from the own source of the customers. If you look at our kind of customers who are self-employed, unlike salaried customers, they get some business inflows, bulk inflows from their business. The first thing they do is to close the housing loan. So if you look at our total pre-closes, it is around 7%. Of that, 4.49% is out of own source. The balance transfers are around 2.5%. And this 2.5% has been maintained by us for the last 15 years. So we don't see that kind of an impact because of the balance transfers. Yeah.
Got it. So, no major impact despite high yields and peers. And so lastly, if you can just share the login to sanction ratio and this for the quarter as well.
Login to sanction ratio is around 78 to 80%.
Got it. And that has remained stable through the year?
Yeah, it has remained stable across. Yes.
Got it. Thank you, sir. That's it from my side.
Yeah.
Thank you. The next question is from the line of Manika Bansal from Master Capital Services Limited. Please go ahead.
Hi, sir. Thank you for taking my question. So my question is on branches side. So you have opened 10 branches in Maharashtra and Odisha, right? So what is the plan and opportunities do you see over there?
If you look at our strategy, we have always been growing on a contiguous basis. And that's why we chose Odisha and Maharashtra, because it is closer to the states of Telangana and Karnataka. And Andhra as well. And the initial experience has been very good. The people there are good. The credit quality is good. And of course, we are a credit-driven organization, so we choose our customers properly. And these two states are offering good scope for increase in the disbursement and also the consequent loan book. So with that in mind, we'll be opening 10 more branches in this current year and increasing the loan book there.
Okay. And one last question. What is the 1 plus DPD?
1 plus DPD is around 7.5%.
Okay. Thank you.
Thank you. The next question is from the line of Karthikeyan Kumar from Ashika Stock Broking. Please go ahead.
Hello.
Yes.
So you're audible.
Yeah. So congratulations on healthy numbers. So most of my questions are answered. I just wanted to understand this presentation that you have made. Like if we come to page number 8 of your PPT investor presentation. So here you have taken your total income for calculating NIMs. So is there any reason for including fees and commission income in the line item? As I just wanted to understand the perspective of this.
No, NIM is, see, whatever is as per the clause 41, that is being computed. In the clause 41, interest on FD, all those kind of income is getting added. So that is how the NIMs are computed. If it is specific to ratio computation, I can take you offline and then see, I can give you a full explanation.
Okay, thanks.
Yes.
Thank you. The next question is from the line of Amit Javed from Javed and Partners. Please go ahead.
Right.
So Amit, I would request you to unmute your line and speak, please.
Understood, sir.
Hello. Due to no response from the current participant, we will move on to the next participant. The next question is from the line of Nidesh from Investec India. Please go ahead.
Sir, thanks for the opportunity and congratulations for a good set of numbers. And it's heartening to see that Tamil Nadu growth has come back, which I think is good.
You're best subject, Nidesh.
Yeah. So, what is the guidance for next year in terms of disbursement, overall disbursement growth and AUM growth for FY26?
The AUM growth, we are guiding around 28 to 30%. Disbursement growth will be the resultant, around 24%, 23, 24%, or maybe 25 as well.
Sure. And secondly, I noticed that we have
I explained the strategies on how the growth is going to come. Hope you had listened to that. Yeah.
And secondly, this assignment income, I think this is the first time we have done assignment income.
Yes.
So why there is a change in strategy and how should we model it? What percentage of AUM will be assignment done on an annual basis going forward?
See, actually, the thought process of direct assignment came in, first we wanted to test this transaction because we have not done this for years, and we wanted to do that and test how the portfolio of Aptus is being felt by the persons who are buying the portfolio. That is the first thing. And also considering the evolving funding environment where RBI has also been insisting on diversifying the borrowing. And so that is one thing which has triggered this thing. Third thing is, of course, it is a ALM management tool. That is also the third one. The fourth thing, the major, more important thing is to improve on the principal business criteria. If you look at our principal business criteria as of 31st March, it has improved to 64.3%. So that is more of the thing. So going forward also we'll be doing selectively. I mean, it is not that we'll be going very aggressively on this assignment because so maybe 150 crores every quarter we might be considering doing this.
No, actually just to add to what Mr. Balaji said, I mean, this thought process in terms of, when all of us are aware that the financial metrics of Aptus is one of the best in terms of ROA, ROE, and our ROE in the fourth quarter crossing 19%. Despite this, attractive financial metrics, when it comes to inter-firm comparison with other housing companies, other NBFCs who have been pursuing joint assignment system for almost 3 to 4 years, somehow in this inter-firm comparison, this is in our view it is sort of ignored. In the sense, our numbers are always compared with all the other companies who are booking the assignment income. Thereby, their NIM and ROE, whatever reported, incorporates income arising out of the assignment. Whereas our income is not. our returns are not. So we would have also want to, in the end of the day, when the investors and analysts look at the interfund comparison, we are really at a disadvantage. And that's also a factor which we have been taken into consideration in addition to the various other elements like diversification of resource, principal, defining principal business and things like that. So this is something which we have, we have discussed in detail and taken a decision.
Got it. Thank you. So in this segment, are we doing housing loan or non-housing loan?
We did the 75 crore assignment of non-housing loans in the housing finance company.
Okay. And the cost of fund from this...
No, sorry, that's where the issue of principal business comes in terms of housing company. Yeah.
And then lastly, what will be the cost of funds from this source of funding assignment? Is it better than our overall cost of funds or?
It is around 9% for a yield which is giving us around 18.5%.
Okay. Great, sir. That's it from my side. Thank you.
Thank you. The next question is from the line of Rakesh Kumar from Valentine Advisors. Please go ahead.
Yeah, hi, sir. So just firstly, one question on the LM side. I was looking at the average tenure of the borrowing is around 7.5 years, and average loan book tenure is around 9 to 11 years. So, this interest rate cycle would not, just the LM positioning would help on the margin expansion?
No, if you look at the ALM, what we need to look at is what you rightly said is on the asset side, it is around 10 to 11 years. On the borrowing side, it is around 7 years. So there is a small gap. But if you look at the leverage again, our leverage is very low. So to that extent, we are comfortable on the ALM. And even as of today and going forward also, all the buckets, it is surplus. That's because our spreads are around 9% and the NIM is around 11-12%. So we don't see a problem there, and we want to limit the leverage to maybe 4 to 5 times. So that's how the whole ALM issue also will be managed.
And secondly, sir, with reference to, borrowing equity breakup and, floating rate loan around 19%. So in this interest rate cycle, 38% kind of funding part of floating rate loans. So how much would be the drag in terms of, the margin, because of the rate cycle?
Actually, we stand to benefit, right? See, what is happening if you're on the asset side, if fixed rate borrowings is 80%, I am not under pressure to pass on the interest rate benefit which is going to come in on the borrowings, on that 38% borrowings, to the customers. So, as compared to other companies, we are at a slightly advantageous position in terms of spread improvement and NIM expansion.
No, what I'm trying to say that 19%, approximately 18.6% of the loans are floating rate, right? So anyway, that rate is going to come down, and that is being funded by the equity, which is 38% of your total borrowing and borrowing mix or which you're using in the business. So basically, on the asset yield side, your yield is coming down, which is being funded by the fixed rate kind of equity, though it has a cost of equity, but just from the accounting perspective, it will compress the margin, right?
But on 19%, even if I have to reduce it by 0.25%, what will be the compression that will come in?
And that is taken care of by the non-reduction in the loan book. Yeah.
Sorry, I missed. There is some overlap. Could you come again, sir?
See, on the 19% of the loan book, even if I have to reduce by 0.25% because of the interest rate benefit that I'm getting, what is going to be the impact? Because 80% I'm not going to reduce at all. So that will be offset. That's what we are trying to explain.
Correct.
Yeah.
It will be marginal, but I was just thinking that how much.
It will be very marginal. We can discuss it offline for the specifics. Yeah.
Sure, sir. Sure. Thank you. Thank you, sir.
Thank you. The next question is from the line of Mona Khetan from Dolat Capital. Please go ahead.
Yeah, hi sir. Just a few questions from my side. So firstly,
Sorry to interrupt, ma'am. Yes.
yeah, is it better?
Yes.
Yes.
Yeah. So in your PPT, you've given this time the average ticket size in housing book. It's about 9.2 lakhs. So this is the incremental average ticket size, right? At a portfolio level, it should be a tad lower. Is that a fair understanding?
It is on the it is not at the portfolio level, it is on the sanctions.
Got it.
Current year, yeah.
Sure. And when it comes to your bank borrowings, what share is fixed rate bank borrowings? If I'm correct, you do borrow at fixed rate from banks. And what is the typical tenor in those borrowings?
44% is the fixed rate, and typical tenor is, if it is bank borrowings, it is around 5 years. If it is from NHB, obviously it is 10 years or 15 years.
No, so of the total borrowings, 44% is fixed rate, but of the bank borrowings, how much is fixed rate versus floating?
I don't have that number. I'll communicate to you, yeah.
Okay. And within that, what is the typical tenor when it comes to bank fixed rate borrowings? Is it also 5 years typically or lower?
Yes. We don't borrow lesser than 5 years. So that is very clear. But this specific number, I'll get back to you.
Got it. And on the when I look at your self-employed versus salaried mix, if I look at the last couple of quarters, the share of self-employed has increased. So how do we read this? Is it driven by some regional factors or any change in lending approach? A few quarters back, it was almost self-employed share was almost 71, 72. It's increased to 78. So how do we read this?
No, it's not a major increase, Mona. The thing is 72 to 71 to say 73 or 74. But the thing is our kind of customers are self-employed customers. That philosophy doesn't change for Aptus. The salaried customers are basically they are cash salaried customers, plus one member in the family will be running a business or something like that. So that is what is getting classified as salaried customers. So the underlying for any of our customers is mostly self-employed people and mostly giving essential services.
Got it. And just one thing on the assignment portfolio that you did. So incrementally also, we plan to do only non-housing portfolios to benefit from the loan mix requirements.
Yes.
And how large could this be as a share of the AUM?
No, actually, I told you, we are not going to be very aggressive on this front.
Okay.
Maybe 100 to 150 crores a quarter, we'll be able to do this.
Sure. Thank you so much.
Thank you. The next question is from the line of Aman from Phillip Capital PCG. Please go ahead.
Hello, am I audible?
Yes, Aman.
Yes. Hello, Mr. Balaji, and congrats to the management team on a strong quarter and good results.
Thanks.
So my question is specific to Odisha. So I think one of your peers also, the bigger peers also tried going into the state, but didn't really have much business there. So is that something that is sort of, slowing down our expansion plans in any way? Because I see, so if I remember correctly, you have mentioned about 10-15 branches every year and potentially 10-15 branches in Odisha and Maharashtra over the next couple of years, right? So, is that something that is weighing in on you?
No, what I mentioned was 10 branches in both Odisha and Maharashtra. So that means 5 branches more in Odisha this year. And if you're asking specifically about Odisha, we are actually having very positive response. And the loan book which we have built is very strong and the repayment patterns are very good. And we will continue. See, the thing is, how we select the customers is the differentiator. See, if some other company has ventured into this state and they were not successful, that doesn't mean that we will not be successful. So the thing is we are a credit-driven company. We will be funding the same profiles like what we fund in the other states. So this will continue, and we will continue to choose our customers correctly. So that is how the Odisha portfolio will grow, and we are very confident about that state.
No, I get your point, sir, but so of course, I do not want you to comment on the competitor, but I would like to know what is working for you really, because you have the option of choosing the borrower, right? But the borrower, of course, has many other options, your bigger lenders and, some regional players. So what is working for you that is driving the borrower sort of, to come to Aptus for a loan?
Just to add a point here, while we can look at the Odisha as a state, in Maharashtra state, that's one thing. But as Mr. Balaji explained, our strategy is continuously expand. And meaning that we are already present in Andhra, Telangana, and Maharashtra. And we are starting our entry into Odisha and Maharashtra in the adjacent districts only. The adjacent district of, for example, Odisha, which is connected with Srikakulam in Andhra and Vijayanagaram in Andhra. Now, the adjacent districts, the culture of the people, the culture, the earning is almost same as the Andhra adjacent, districts like Srikakulam and Vijayanagaram. Similarly, in terms of Maharashtra also, we are present in Telangana and Karnataka, and we are really starting with the adjacent districts and progressively we'll build it up, over time in the state. That's one element. So in other words, they are not really totally new, because the Odisha is not, at least the 5 branches that we started last year, they are really serving the adjacent districts of the Andhra Pradesh. Okay. And now going forward also, this is one element. Second is really our credit underwriting is lot more, we believe, is lot more relevant and deeper. And with the philosophy that, whatever business that we do is going to be, credit driven rather than disbursement or sales driven.
Okay, got it, sir. I think that broadly answers my question. And so my last 2 questions will be on disbursements and the India. So a couple of quarters back, I remember Mr. Balaji mentioning a bit about some issues in Karnataka with respect to the e-Khata, right? And one of your peers again mentioned that to an extent these issues have been solved. So have we seen any disbursement pickup in the state of Karnataka?
Definitely, there is a good disbursement pickup. If you look at last year also, I think there has been a good growth. Just 1 second.
Okay, and sir, one last question would be in the Maharashtra disbursement. So are we seeing any sort of competition in terms of the rates? Because I think Maharashtra is a fairly competitive state with a lot of lenders, right? So are we seeing any pressure on our incremental disbursement fees?
No, but as Mr. Anandan also explained, again we are in this contiguous expansion mode where Maharashtra, just to give you a broad guideline on the Karnataka, it is around 26% growth has come. So the e-Khata issue has got solved and the growth is coming back in Karnataka. That is one. Now coming to Maharashtra, again this contiguous growth is being followed, and most of the branches are close to Telangana state, where the credit culture of these people still spills over to these branches. So we are not seeing that kind of pressures on the yields, and we'll be continuing this kind of growth in this state as well.
Okay, fair. So just to conclude your explanation, so you're sticking to the border states where the culture is pretty similar to the current states, and of course the base is fairly small for us, that we do not see much of yield pressure.
Yes, absolutely.
Yes. Okay, perfect. Thank you, sir. That answers my question. All the best for the next year. Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Shweta from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity, and congratulations on a good quarter. So a couple of questions. So can you provide some color on gross stage 2, because sequentially the absolute has remained slightly sticky. So should we attribute this to a particular geography, or say concentration of quasi-home loans, or business loans which are contributing to this. Even the ECL has sort of gone out there. So yeah, that's my first question.
No, basically stage 2, we are not seeing any stickiness across products or across states. If you look at 31st December, it was around 504 crores. It has gone up to 507 crores. Of course, on percentage terms, it has reduced from 4.93% to 4.72%. So we are not seeing any kind of thing, pressures on the stage 2, and we have been, it is slightly better in this quarter as compared to the last quarter.
Okay. So it's broad-based. So basically no concentration.
Yes.
Okay. So my second question is, so who are the takers of our BT out cases?
There are some NBFCs who take our loans, maybe banks, small finance banks, and some of the NBFCs. No, I don't want to name them, but it is that way. But the amount is very small. Yeah.
Sure. Noted, sir. And so lastly, what is our employee attrition run rate, and how are we in terms of incentivization vis-a-vis industry standards? Thank you.
If you look at attrition, at the top management level, there has been nil attrition. And at the middle management level, comprising of cluster managers and everybody, area managers, it is around 4 to 5%. And at the branch manager level, it is around 10%. Of course, on the field level, as compared with the other companies, our attritions are also slightly high, around 40-45%. So one thing is, we have introduced a scheme on retention incentive, and of course, handholding them for first 3 months to perform better. And if a person stays in the company for first 6 months and is able to contribute to the company with 2 logins or 1 login per month, we try to incentivize them by way of a fixed amount. And of course, our disbursement and login incentive policy per month, if they are able to do more business, their income levels are also going up. So those are some of the things which we are taking care to control the attrition, and hopefully that will improve in future as well.
Okay. So just a follow-up question. So what is helping us driving down our OPEX on the cost front? So I'm not talking about cost income ratio or OPEX to asset. In general, we've been doing well on OPEX driving down. So which are the key components which are aiding that?
No, it's actually everything. If you look at it, if you look at our salary and incentive structure, it is more driven by productivity rather than the increase in the cost. So we demand productivity in whatever we do. And similarly, if you look at other expenses, even if it is IT, we don't go for many big names. We just have persons who develop it for us, and at a maybe very reasonable cost, but it has the same features as anybody else is having. So that is one thing. Then the next thing is we are wired that we are frugal, and we don't want to spend very much on our branch infrastructure, because we strongly believe that the people at the branches have to be on the field, be it sales or credit or collections, who has to do more business or more collections. So we have a basic infrastructure which provides basic furniture, internet and telephone connectivity and maybe computers. So these are all the things. So it is not one thing which is driving this cost down. It is basically all round things.
Sure, sir. That's helpful. Thank you so much, and best luck for your future endeavors.
Thanks.
The next question is from the line of Amit Javed from Javed and Partners. Please go ahead. Amit, I would request you to unmute your line and speak, please. Due to no response from the current participant, we will move on to the next participant. The next follow-up question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, thank you for allowing a follow-up. Sir, just wanted to check on a couple of things. So again, circling back to the cost, so we are confident about achieving the disbursement growth and the AUM growth numbers that we've spoken. with the same cost structure in terms of, say, employee salary, incentives, even the locations where we are present?
Definitely.
Commission is given out? Yeah.
No, definitely, Rajesh. See, if you look at it, I explained the strategies on how we are going to get the growth. So basically, all this, the strategies which I've told, has the productivity element imbibed in that. So there is no compromise on the productivity. So definitely, we will be able to achieve this at these cost levels.
And so one thing, the rejection rates for the logins in FY25 versus FY24 were stable or higher? Because I think in one of the previous answers you said that login to sanction ratio has been stable, implying that rejections have also been stable.
Yes, absolutely. It has been stable all through the years.
Yeah. Got it. Yeah, that's it, sir. Thank you.
Yeah.
Thank you. The next follow-up question is from the line of Kushan Parekh from Morgan Stanley. Please go ahead.
Thank you for taking my follow-up question. I just had one question. If you could help us refresh your credit cost guidance. I see that we have put out in the press release at 40-45 basis points. But I just wanted to understand this a little bit more and contextualize it in light of the accounting change that we had with the auditor change, where we are now netting off the bad debt recoveries from our credit cost, and also from a point of view of provision cover that we would like to maintain on the book, essentially. So if you could just help.
Richard, we were not able to hear you properly, but there was some echo. But what I understand is you want some guidance on the credit cost, correct?
Yes, in context of the fact that we have this accounting change with the new auditors, with netting off of bad debt recoveries now within the credit cost.
That is just an accounting treatment. So the accounting treatment will not have any this thing on the credit cost. See, what our guidance on the credit cost is around 40 to 45 basis points. So that is the guidance, but we want to better that, but because by way of more bad debt recovery or something like that, but the guidance will be around 40 to 45 basis points.
Understood. And that would be gross of bad debt recoveries, right?
Yes, absolutely.
Okay. All right. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
Yeah. Thank you, Mona and others, for organizing this conference call. I would like to pay my sincere gratitude to all the analysts and investor friends who have taken time out to participate in the call today. Please feel free to connect with us in case you have any further questions. Thank you.
Thank you. On behalf of Dolat Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.